Hello, everyone, and welcome to BFW 2401. This is lecture 1, week 1, semester 2, 2023. Today, we are talking about financial institution specialness. Now, I choose to divide this lecture into 4 parts of recording. You can look at that also when you go over the slides. And the reason I did that, so maybe I transfer the ideas in each part and reasonable pace and reasonable time. And I hope you will find it useful and you can go over it in a way that you can understand it and you can use time also efficiently. Now, if you allow me to share my screen, this is actually the commercial banking and finance. And as you can see, I am referring to what we call lecture 1 and chapter 1 and 2. This is, I'm referring to the book. Remember, please, that we are not using a book and you are not required to use a book, only open resources, but I'm using Long et al. 2015. You can use Long et al. 2015, and the link for the book is actually in the resources if you want to read about it. Otherwise, the recording and the slides, hopefully, there will be enough. Now, for this week, this is the learning objectives, and I don't want to go over this 2-3 slides. I will just go to here, and this is the learning objective of week 1. So actually, we want to know the difference between banks and commercial firms. There's differences. Banks are working as financial intermediaries, providing services, while commercial firms like industrial companies or trade companies or all this type of all those sort of companies are working actually in projects, some of them also using provide services, but banks and financial institutions are specialized in the financial service. Now, we want to know, which is the most important thing, what banks can provide to the public and to the economy. So we want to see what services this banks can provide or financial institution can provide to the household. And when I say household, I'm referring to the investors or depositors of all sorts of and sizes. Now, number 3, we want to see if banks is highly regulated. They are highly regulated, actually. And the reason why they're highly regulated, because they are very important to the economy and because they provide those services. So if they fail to provide these services in a proper way, they will damage the economy. They will spread, there will be a ripple effect that will damage the whole economy, and therefore they are highly regulated. Unlike commercial firms, these banks actually are under strong scrutiny by the central bank, which is Bank Niger in this country. Now, banks actually view these regulations as a source of making them less efficient. This is from the perspective of the banks. But so we want to look at this objective and see the 2 scenarios from the industry and from the supervisor. And when I say supervisor from now on, I mean the regulatory body, which is the central banks. Now, bank failure can provide systematic risk, as we have explained it. So this is what we want to talk about in this lecture, but specifically, we want to concentrate on this, which is the services that they provide. Now, this is maybe the most important slide among all of them, which is, this slide actually is the one that shows how the money moves from the households to the corporations. They can move with without intermediation, which means without the financial institutions. And this is the operations we see in the market. So corporations issue stocks, some bonds, and other financial securities, and the households will buy them, and they will receive either dividends, or if they buy bonds, they will receive coupons or interest, and this is how they invest. And in this case, the connection between the household, which is the savers, and the corporations who need the money, so we call this the surplus part of the economy, and this is the deficit sector of the economy. So the money actually moves from those ones by so they move in this manner, and you can see the flow from the funds come from the savers to the corporations, and this is the cash they bring, and the corporations will give them claims. Those claims is actually equity. When we say equity, is equity the shares they give to them, or the debt when you hold the bond, and they give you either interest for the bond or dividends for the shares. This is if they are going to do that. We are not concerned in this, and this is, we call it without intermediation, and it's actually related to the market. What we are concerned about is actually the second part, which is this one, which is with the intermediation. Now, with the intermediation, as you can see now, we can still use this one. So the money will come from the households to the corporations, to the brokers, which is now the bank is actually here, and it act as intermediary. And this intermediary actually is the one who will provide or who will send the money to the banks. This is the intermediary. So the intermediary will take the money, which is the cash from the household, the what we call the surplus sector in the society, and then they will transfer it to the corporation. Now, this is actually what's happening. So as you can see now, it's two steps, one step from here, and the other step is to here. How do they do it? So we bring cash when we open account, for example, saving account or deposit account, saving accounts or fixed deposit account, or we invest in any funds by the bank, we provide cash, and they give us certificates in this for this cash, and then they will take the cash, as I told you, and they bring it to the corporations, and the corporations will issue equity and debt to the financial intermediary. Now, the financial intermediary will buy all this money and returns and start to distribute it to the depositors. And the if we are talking about insurance companies, we buy insurance claim, and the insurance will give us insurance policy. And then if it is life insurance policy, when you retire or when you pass away, that insurance policy will be cashed. So this is how it works in insurance companies. But in banks, they will return for us a return. And if we want to withdraw our money, of course, we can withdraw our money. Now, the thing that we want to understand now, this is new terms. So this debt and equity provided from the corporations to the financial institutions, we call them primary securities. And the saving accounts that they are giving us, or the insurance policies, we call it secondary securities. Please understand those terms from now. Now, let me talk about something else now, which is how the bank does it. The bank can act as a broker. In this country, we have so many banks who work as a brokers. So they just buy for you those primary securities, and they can give it to you directly if they work as brokers. But what banks do actually, they took a fees, of course, if they act as a broker. CIMB do it here, Goldman Sachs do it in the US. Huge banks do brokerages service, and they actually, it's not like the asset transformation. The asset transformation will give you a secondary securities, and they will buy primary securities for themselves, and they will issue for you secondary securities. But if they act as brokers, now the primary securities will be either through a fund or where they can act as a fund. So you participate as a household in a fund. The bank will act as a broker, and they will put it in a primary securities. Or they can buy to you directly. Now, this is how it works. So let's see what, now we already understand the primary securities, secondary securities, and let's look at those issues now again. If you want to read about it, this is the brokerage service functions, and this is the intermediation function, which actually I explained to you. So when you issue loans, when you receive deposits from the households and you put it as loans, it actually becomes an asset transformation. But if they just buy for you bonds, when we say asset transformation, which means they transfer your money here, which is small deposit in your account here in the primary security in the deposit, and they make it as loans, or they make it as long investment. So this is the asset transformation. The brokerage services, as I told you, they just do that whether you are participating in a fund or they can buy stocks for you, and actually they take fee. Why they do it better? Because the economic of scale. They can do it better than us. They can go to the market because of the economic of scale. They have less transaction cost. They have less information cost. They have less monetary cost. Now, let's see why the household find it unattractive to invest in corporation, which means when we talked about without intermediation, why they prefer to work with banks in this part with intermediation and not actually to go to the market directly like the graph I showed you before. So the reason is actually because if they invest in corporations, they need to monitor, which means they will be high agency cost, which means the insiders may use the money of the outsiders, which is the shareholders, and they can lose their investment. So to decrease that, you have to do monitoring, which means you have to follow and see how the corporate governance is working and how the investment is doing. And you as an individual investor, you cannot do that. Only huge banks where they can sit in the board of those corporations, they can do this monitoring cost. So as an individual, actually, you cannot do monitoring function, and therefore your monitoring cost, if you want to collect information about the company you are investing in, you want to go there, you want to go to the general shareholders meetings, you want to write to the board, you want to do all these things. If you are actually small investors, nobody even will give much attention to what you are saying or doing or writing. Now, they have also a liquidity cost. So if you are investing in banks and you want to withdraw your money, this is what we call it liquidity. You can liquidate your investment at any time. You can withdraw all the money from your what we call investment account or saving accounts, or you can even break what we call your fixed deposit and receive your money back. So this is what we call liquidating. Now, if you are investing in stocks or bonds in the market directly, when you want to sell them, usually you will make some losses. There is something called spread, which is the difference between the buying and the selling of your investment. So if you want to sell them and rush, now usually you will have some losses, which we call it liquidating liquidity costs, which means you have to sell it less than the market price. Now, there is also another problem, which doesn't happen in banks. In banks, if you put your money in those accounts, saving accounts, or even current accounts, or what we call fixed deposit account, or even investment with the bank and funds they are running, your principal will come back intact. They will not touch your principal. Maybe the return they give you is less, but the principal will not be impacted, and you can withdraw your principal anytime. If you invest in corporations, now, as you can see, the stock prices go up and down, bond prices go up and down, and you can make a lot of losses. So the price risk is there. Because of these three issues, the monitoring and liquidity and price risk, you will find it actually unattractive. It becomes unattractive because of all those risks for the investors to invest and directly in the market, especially if they are naive investors or small investors like me and you. So financial institutions actually stand between the households and the corporations and let them avoid all those problems. Now, what would happen if there is no banks? If there is no banks, and I am as an investor and I have money, either I will decide to hold my money as cash and not invest it at all, and this is very damaging to the economy and to my individual well-being and for my also wealth growth. Or the other thing is to invest in corporate securities. This is if there is no financial institution exist in the financial system. And therefore, I told you, if they invest in corporations, they will have these three problems, which is a monitoring cost, liquidity cost, and price risk. So this is what's happening now. Maybe this statement is just to let you know what's going on live. Actually, bond issuers, like those huge corporations, when they issue bonds, they usually, investors, big investors, they will ask for some terms and conditions. We call it covenants, like terms of conditions for this issue of bonds if they are buying it, which they make some limitations. They put some limitations on the issuer so they can guarantee to somehow their investments. So this is the whole issue, and I want you please to be sure of this slide specifically. I'm done with this part, and we will record the second part. Thank you, and I will see you in the second part. Bye-bye.